Most traders fail because they try to sell in an uptrend and buy in a downtrend. In STC, meaning Smart Trade Circle. So I'm hosting a blueprint. Our first rule is to follow the big money. If you don't understand market structure, your indications do not matter. I'm showing you how to read the market's heartbeat. So let's get right into it. So for example, what you are seeing here on this part here, which is being highlighted now, this is an uptrend. This is what the market does in an uptrend. It goes higher than this high, and it goes higher than this high to complete the uptrend. Now, in a trend, there are two things that are involved in making a trend. And what are those two things? They are called higher highs and higher lows for an uptrend. So for an uptrend, we have higher highs and higher lows. While for a downtrend, all right, so with that being said, you now understand the difference between an uptrend and a downtrend and a break of structure. Now, mind you, the market does not just move in an uptrend or a downtrend. There's also some a market movement called consolidation, and this is an example of consolidation. This is a consolidating market. What is a consolidating market? A consolidating market is whereby the market makes a strategic or a very visible high and a very visible low, where and any other market movement does not go past it. And even if the market goes above or below this and it reacts with a wick, we still classify it as consolidation. So this is basically consolidation, and I would really advise you to avoid a consolidating market. With that being said, now, how do you now understand to know, okay, this market is now switching from an uptrend to a downtrend? All right. So what we do here is we use a simple strategy called the change of character. So as I said before, this is a break of structure, and what we can see here significantly here is that this whole part is still an uptrend. Now we see that there was something that happened, something unusual happened, and if we see that in this uptrend, we know that this is a higher low, but in an uptrend, the market is not supposed to close below this higher low. So anytime the market closes below a higher low, it means that the market is about to change the movement from an uptrend to a downtrend, depending on what structure the market is sitting on. So in this point, we see that the market now broke below this higher low, which is not supposed to happen in an uptrend. So what do? We know that the market is now going to retrace to a supply zone to continue selling from. So at this point, as a trader like you or me, when I see something like this is a very good opportunity and a very good high probability trade that the market is now moving from an uptrend to sell to a downtrend. So what do? After we see or we identify this change of character, now we look for a supply zone just above there where the market could sell from. That also applies to this. When the market is in a downtrend and it breaks with a body above a lower high, then creates a new, this is what, a higher high. When it creates a new higher high just above this high and lower high, then we know that the market has changed from a downtrend to an uptrend. And I'm going to be showing you that real quick now in the real markets. Now, what we have pulled up here is the USD card. All we have here, right here, is the United States dollar against Canadian dollar. So from what I have explained, now what do here? We have to identify the trend. So I'm going to be using this tool. So let's get it started from this point. Now from here, we can see that the market is making significant higher high, a higher low. Now it's created a new higher high, a higher low, created a new higher high. Now came here, created this higher low, and the market was not able to do what? Create any significant higher highs anymore. Now we saw that the market now went just below this recent higher low and closed with a body. Now what does this tell us? We know that from this point of the market, now we see that, let's just clarify it more. Now this is a break of structure. Now we can identify another break of structure here. Now, this was supposed to create a new break of structure, but we see that the market didn't close, and now we are seeing that the market wasn't willing to go higher. Now, what did you see? This was the most recent what? Higher low. Now we can identify here that this higher low was broken or was changed by this market body. Now, if you go to a higher time frame, this is the 4-hour time frame. So now we can see that immediately the market closed with a body below this recent higher low. We saw that the market started was selling. Now we can see significant sales from here. We see that the market started drifting. This was a very big impulsive move. Now we created this, came up back, came here. Now we are seeing that new lower lows and lower highs are being what formed. So that's basically what I talked about. So now you might say, okay, because you know that when I draw something, when I was giving an example here, let's get that example started. I made an instance that when the market comes down up to this level, let's say it comes down to this level, it should reverse to this place. Yes, mind you, that doesn't happen all the time. That doesn't happen all the time. So there are most times you get tapped in, there are sometimes you will not get tapped in. So in this case, we see that we didn't get tapped in. But for me, an ideal trader, what will I have done if I saw this kind of opportunity in the market? Now I'm going to break that down to you. Now we can see that this was where the market, this point was where the market was, gave this change of character. And on the higher time frame, on this 4-hour, you can see that this was an impulsive move, which started from where? Now, in case you are wondering, I use supply and demand as my strategy to trade. So let's go to the 2-hour time frame, the lower time frame, to classify and understand it better. Now, what can we see? We can see that at this point, this was the supply zone that broke this structure. So just to refine it more, we have this supply zone here. Now we also have, okay, this is not a supply zone. So from looking at this now, from this 2-hour time frame, we can see that this is the only supply zone. And how do you identify a supply zone? I identify my supply zone as where we see an imbalance. So at this point now, we can identify that there is an imbalance here. Okay? Now from this point, we can see that there is an imbalance, or what you would like to call a fair value gap. So the candle, or the immediate candle before the fair value gap, that's massive move, is what we classify as a demand or a supply zone. So with demand, a demand zone is where we buy from, and a supply zone is where we sell from. But the most important zone between the two of them is a demand zone, because demand is what brings about supply. Okay, so we can see that this supply zone was formed here, and at this supply zone, we saw that the market created something called an inducement. Now, this is an inducement. This I'll classify as an inducement because I'll be expecting the market. Let's say the market came back with, I'll be expecting the market to come around here. Now, fake people out that, okay, give people, some traders, the idea that, all right, I'm already going to sell, give a little sell, push back up, probably with a week, come here and make the big or the main move that the market wants to make. So creating equal what highs here. When it creates this equal highs, this is now classified as inducement. So anytime you see this kind of SSS on my chart, it means that this is inducement. All right, so this was the ideal trade for me to take. And one thing I like about my strategy is that it gives you high probability trades. So like I said, if the market came back, let's say the market gave us an opportunity to sell from here, this would be a very ideal place to sell from. So I will set my stop loss just below or above my supply zone. Then I can maybe, let's say I want to use a swing point for my take profit. So let's assume that I used here. This is what the trade is going to look like. So let's say the market came and tapped us in. This is a 9.16 ratio, and this is a very good risk to reward for this kind of strategy. So basically, what we usually use, or what the most important strategy you need to know before trading, is market structure. Because without having a full or a good understanding on how the market moves, then I don't know what you are doing. I'll just classify you as a gambler. All right, so this is where I'll be ending this video. I hope to see you on my next video. Thank you.